Joining us now is Unlimited CIO Bob Elliott and Citi U.S. equity strategist Scott Chronert. Good afternoon to you both. Bob, you're here on set. I'll start with you. Your response to what Mike just had to say, especially as we've seen stocks lower this quarter and bonds by price lower this quarter. Are either one of these compelling investment stories right now?
Well, I think the biggest thing to look at is what's going on between stocks and bonds. The long bond down 15% this quarter. To say that we haven't had a valuation problem in stocks, that stocks are getting cheaper, that's not right. When you bring the discount rate up the way we have, 80 basis points, and stocks haven't gone down anywhere near as much to offset that, basically we have stocks today that are meaningfully more expensive than they were at the start of the quarter, and they were already close to all-time highs at that point. And so that's a pretty challenging environment given we've got some of these difficult economic momentum dynamics going into the fourth quarter.
Scott, how do you see this quarter, and maybe your thoughts also on this impending government shutdown? Folks at Citi think it's going to be a week or less, so is there something you'd buy on knee-jerk reactions if we get them?
Well, I think the way we're viewing the shutdown risk is just that, more of a volatility event, and we don't think it'll have a material effect as long as it's contained within a shorter time frame on longer-term fundamentals. So the bias from our perspective would be to buy that volatility event. Now, in terms of the Q4 outlook, yeah, we've had to deal with this backup in rates, which is pretty obvious at this point. It's interesting. Our fair value work is that equities are actually towards the high end of our fair value band. So while we've been focused on this for some time, I think the issue really from a flow perspective is that the modeling still suggests bonds over stocks. So we have to contend with that. Okay. Third component, though, is that we're going to be going into the Q3 reporting period. Here we're looking for a fairly straightforward quarter with normal positive surprise ratios. The setup increasingly, though, should be for a positive earnings ramp into 2024. That's what keeps us positive into the end of the year.
Okay, so, Bob, you say we're late cycle. Recession's right around the corner. And cyclicals are weakening. So conventional wisdom would say late cycle, you buy what? Utilities, materials, industrials, that kind of thing. And utilities is one of the weakest sectors in Q3, down 9% alongside real estate. Is there opportunity there?
Well, you've got a basic situation where those long end yields rising are affecting those cash flows, right? Much in the way of real estate affected by the long bond, as well as utilities affected by bond yields as well. I think what it highlights is this overall market dynamic where most of the easy money being short bonds has been made, and now the question is what asset in that market looks overvalued right now. It sure isn't bonds, right? It's stocks, which over the last couple of years are up 60% relative to long bonds, right? Long bonds are down 50%. Stocks are doing pretty well, holding up. That's the big discount. That's the big divergence in the market that eventually that has to get closed. That dynamic is going to get closed. And as economic momentum deteriorates, that's only going to get move faster to closing in the fourth quarter.
Scott, I want to get your thoughts on what we've seen in terms of earnings, because earnings revisions as we go into this next season have actually been, I think, more positive. How does that set us up in terms of the possibility of upside surprises? And I ask that because, yes, we're coming out of this seasonally weak period, but we also have these decidedly unseasonal factors that are going to add to the mix, too, whether it is the student loan repayments or the higher oil prices or government shutdown, depending on how long that goes, or UAW strike.
Yeah, I mean, you're right. The consensus bottom-up expectations for this year have moved from 217, 218, sort of 2-3 months ago to 222 now. So there has been an upward bias to the numbers. Again, recall that we're at the high end, or for the most part, the high end in terms of our 24 outlook, looking for 245. So color us more bullish on the earnings outlook from here. What I would say on this is that what's happened with this pullback is that our measures of implied expectations around earnings have come in quite notably, and we feel like implieds are closer to where consensus is. So it's a fairly decent setup for the Q3 reporting period. Now, again, in aggregate, we're looking for a flattish year-over-year number. But again, I think what we're going to see is an increasing focus in terms of the 24 outlooks. And there, with the recession timing still an issue, I think there's probably a bit of an upside bias to where embedded expectations are.